Hey traders, this is Blake Morrow with Trader Summit. With me today, I have Mr. Jim Welsh from Macro Tides. It's Friday, so good to see you, Jim.
Good to see you too, Blake.
You know, I heard on a radio ad when I was driving around that people really, you can get people's attention by giving people the booming noise, like the booming voice. So, hey, today we have Jim Welsh from Macro Tides. So hopefully, that got everybody's attention. So.
Well, thank you very much.
All right. So, hey, I want to say, the markets this week has actually been a little bit calmer. We've seen the markets grind higher. We've seen equities kind of brush off I don't know, do you call it a wall of worry? But we've seen equities just kind of grind higher up above 4,500. What do you make of this move, Jim, in the S&P and the broad markets in general?
Well, I think a couple of things have developed over the last week. And that's the idea that, we're going to go into a slower growth period. And the companies that do best in a slow growth environment are not cyclical stocks per se. It's the mega cap stocks. So we've seen a very strong rebound in semiconductors, technology, and so forth.
Companies that are actually making money, right?
Exactly.
Okay.
They're making money and, they've proven themselves and so forth. We've also seen just very limited a replay of the meme stocks. You look at what's happened with GameStop and a number of these and Tesla is kind of in this whole ball game too, kind of in both lands. And so that to me has been one of the drivers this week. And last week, Powell, when he testified or gave a speech, no, it was a speech that he gave, National Business Economic Review or something. He emphasized that soft landings have been common in his view. Now, the record doesn't really support that statement.
Okay.
But last year, he kept saying inflation was going to be transitory. Everyone wanted to believe, because that was bullish. And I think what we're seeing, Blake, a little bit is, they're going to do a soft landing. And that's going to be great for me.
So the market's been basically brushing off all the fears of inflationary pressures and everything else for that matter.
Yes.
Thinking that it's going to be a soft landing. But how do you buy into that argument that a soft landing when the consumer is pinched dramatically across the board, almost on everything that they purchase, that's really going to be the case?
Well, I'm skeptical that they accomplish that because of the factors you just cited. I think at some point in time, consumers are going to start to balk at price increases. Coming into this year, there's a big cushion of savings. Wage growth has been ample and so forth, but gradually you work that off. And so the people at the bottom 10, 20% of wage earners are really getting squeezed by energy, food costs. Why? Because a greater percentage of their disposable income go to those areas. So I think what's going to happen, Blake, is gradually that is going to increase from the bottom 10, bottom 20, bottom 30, because food prices are going to continue to push higher in coming months. I don't see that energy prices are going to come down materially. So I think there's a wall coming where consumers will gradually start saying, you know what, out of the pandemic, I was happy to pay anything because I just wanted to get back to normal. And now I'm a little reluctant. At some point in time, I think profit margins start to get squeezed because companies have been able to raise prices. Their costs are going up, they're raising prices. Consumers have been willing to bear that additional cost. I think that's one of the things that's going to change in the next few months or so, which is another hurdle for the stock market.
I'm glad you brought that up. And I'll give you some personal experience that, we were shopping for our family vacation for the summer. And what we paid last year, the prices have actually tripled for the airline flights this summer versus last summer. Now, tripled. Now, it might have been the location, maybe the time we're shopping, but maybe that's outside of the norm. But that, you're right. I mean, at what point do consumers say, I can't pay that. Sorry.
I'm going to go plan B.
Plan B. What's plan B? Well, I'll go back in my backyard and go sit in my pool or, go play croquet out front.
We'll drive 300 miles.
By the way,
get to some nice location as opposed to flying somewhere that we really wanted to go, but we're just going to pay the extra money because once we get there, the hotels and all the rest of that are not going to be any cheaper either. So I just think we're getting, at some point in time, there's a pushback coming.
Okay.
Their balances start to run down, and it will, again, from the bottom up, gradually, it's going to, I think, make a difference. And, you know, that's a reality that really, I just hear too many people assuming that the market's already priced in 7 rate increases because the 2 years at 2% or whatever the 2% is. And my point is, mortgage rates have gone up 100 basis points. That's, you know, housing prices up 20%. Well, housing is going to get hit in a different way because there's so few, inventory so low. Prices aren't likely to really come down a lot, but we are going to see softening, I think, in things like housing. A lot of, you know, home equity lines. There's other consumer interest payments that are tied to the prime rate. So just because the 2 year is at 2%, the prime rate will keep notching up every time the Fed raises the federal funds rate. And there's a lot of loans out there that are tied to the prime rate that will gradually be impacted by this.
Well, Jim, you know, it's before my time. Well, before my time of home ownership and the years that I've seen, me personally, that I've had mortgages.
Yeah.
And really experienced the real estate market firsthand. But, you know, back in the 80s, we had a pretty stagnant real estate market, didn't we? I mean, where
yes.
You know, inventories were really, they just sit for a long time. And you didn't see a lot of movement in price. Is that correct?
That is correct. And part of it, too, is the mentality back then, Blake, was you bought a house to live in. It wasn't per se and perceived as an investment. It was only the last 25, 30 years, if you will, you know, progressively, where people look at, wait a second, I can make a lot of money. You know, I put 10 to 20% down and the house gains 10%. Wow, I've really, relative to the money I put in, I'm making a lot of money. So the mentality has shifted. And you got a whole generation of people who are on that train.
And Jim, and I'm sorry, we're getting off topic here, but I do want to look at, you know, the S&P
Yep.
charts you brought along,
Yep.
but I got to ask this too, because, you know, we're talking a little bit about housing. You know, is the American dream dead of home ownership? I mean, I know a lot of young folks that are in their 20s
Yep.
that cannot afford to buy homes. I mean, is the American dream dead? What do you think?
Well, depending on location, it certainly is. You know, you're in California and other areas that have seen gigantic price increases. You go to the Midwest, like, and you know, house prices in the Midwest in many areas have not gone up that much. So it depends on where you live. But if you live in some of the high priced areas, you know, it's very difficult for somebody to get a job, save, especially if they have, you know, college tuition loans and so on to pay off. And so the reality is people are getting married later, they're having kids later, and all that drives that, you know, that process. It just slows it all down. So,
okay. Well, you know what? We could go so deep into this conversation, which I would love to. I think it's fascinating, really, when you want to talk bigger picture. But speaking of bigger picture, you know, let's talk about the markets. The S&P has been, like I said, it's been grinding higher, and here we are at the end of the week. By the way, it's Friday, and I know maybe it's the time of the day, a little bit of profit taking we're seeing at the end of the week. But what do you make of the S&P and the recent move? And can I show your weekly chart of the S&P?
Weekly chart first.
Okay, let's do that.
Well, you and I in our conversations have been focused, you know, on really the very short term. And I thought, okay, it's time to maybe show a bigger picture. And I know I've referenced it in terms of saying, okay, I think we have this pullback, and after this pullback is over, the S&P is going to go to a new all-time high. And so from the low of, you know, in March 2020, you know, this is the pattern that seems to me the likely path. We've completed 3 waves up, and we've had this correction in the last few months. And the question to me is all of wave 4 done, or are we in the midpoint, so to speak, where the first leg down was wave A, and this is a B wave within the context of another C wave that would take us below the lows of 41.15 before we start wave 5. And the alternative is, hey, the wave 4 is complete and we're beginning wave 1 up. And, you know, that to me is undecided. And if we go to the next chart on the S&P, you can see why. As you can see from the low at 41.15, that initial rally, in my view, was a wave A. It's 3 waves up. Then we had a 3-wave pullback to 41.58 for the B wave. And then you can see 1, 2, 3, and 4. And I think we're nearing the end of a wave 5. But that would only complete wave C of a big ABC. If the bottom is in, what will happen is we'll have a pullback, 43.50 or so, and then another push higher to complete 5 up for what would be wave 1 of 5. And then we're going to get another pullback for wave 2. So for me, it's undecided. Now, on a fundamental basis, I'm leaning toward that this is a big ABC up for a B wave, and we're going to see a decline that takes the S&P below 41.15, because I think a lot of hurdles in terms of we're going to have a slowdown in the economy. The Fed's going to keep raising rates. I think that obviously people get wrapping their heads around the 50 basis point increases. The other issue is the Fed is going to move on its balance sheet. And if you go back to the 2017 and 18 and 19, as the Fed was both raising rates and shrinking its balance sheet, equities on balance struggled. So there's a lot of reasons why I think fundamentally the pattern is more likely to be we finished wave A down, we're in a wave B rally, and then we're going to go down again for a wave C decline. But the pattern is open to both options, and the market will kind of let us know.
Okay, sounds good, Jim. Let's continue on. So the next chart you brought was the Euro chart. Can we talk a little bit about the Euro?
Yep. And last week I just thought we should follow up a little bit. We showed this trend line, multi-year trend line that the Euro had come down and tagged. And I think the Euro was trading about 110, touch over 110 last week when we were talking. And so to me, I believe we're at a point of buying weakness in the Euro. The dollar has not signaled the top yet. So there's the potential, as long as it stays above 97.70, the dollar could have one more pop above 99.50, call it, up towards 100 before the dollar has completed the top. The flip side is it closes below 97.70. So there is the potential that the Euro could spike down towards that 108, maybe a touch below 108, if the dollar in fact gets that spike. But from an intermediate term, you can see the RSI is getting really pretty oversold on the Euro. And so it's ripe, I think, to have some kind of a bounce as the dollar pulls back. And I think the dollar can pull back to 95-ish over the next handful of months. And that
did you say, you said 95-ish, correct?
Yes.
Okay. All right.
The dollar. And so on the Euro, you're talking 113-ish.
Yeah, but in order for that to happen, I mean, you think like logically we have to see the Russia-Ukraine situation, de-escalate a little bit, Jim?
Maybe. Again, I don't think that's likely to happen, just because just the way that Putin operates, and the Ukrainians are showing enormous fortitude. You just have to admire the internal strength of those folks. It looks like this is going to drag on for a while. At some point in time, I think Putin will escalate it in some manner. He just wants to beat these people into submission. So I just, again,
well, I would think that would be like really one of the major headwinds that the Euro would have. In order to really get it to pop to 113, I would think personally that situation would have to change a little bit, but that's just,
it would definitely help. It would definitely help. It's just a flip side though, too. Okay, the Fed's going to raise rates. So they raise a half point in May, and maybe they telegraph at some point in time, people sell into the news in terms of, okay, we know the Fed's going to keep raising rates. The dollar's had this pop, it's up near par. It could just be the natural progression that the dollar is extended and then it has a pullback after everybody's kind of, hey, we've expected the Fed to do this, going to keep doing it. So what comes next?
Right. Okay. But in your view,
one last point.
Yeah.
Currencies trade off of economic perceptions too. We are going to get data that shows that the U.S. economy is slowing. Okay. And that the wild card here in terms of why the dollar could soften.
Okay, yeah, and that's fair enough. I mean, expectations are pretty lofty right now with what people are expecting the Fed to do. So let's turn our attention lastly to the TLT or the Treasury ETF. What are you thinking here? Because yields have been out of control, bonds getting smashed. What's your view at this point?
Well, I think they can keep running. I mean, I basically bottom pick TLT yesterday, buying it around 130, got stopped at 128.60 this morning, that quick. So to me, it was like it was a line in the sand. You can look at this chart and you can see I use a MACD on the RSI, got really close to giving a buy signal before the close yesterday, failed. And obviously today's weakness is driving it further away. The red line is a 5-day exponential on the TLT chart. The green is 13. You can see there's a nice gap there. So we're going to need to see some base building, but I have to keep looking at this and say, you know what? I just think that we're nearing a low, a temporary low that could last, a handful, 2-3 months in Treasury yields where they stabilize and come down a little bit. That would imply a rally to 138 to 140 range on TLT.
So Jim,
I took a bottom fish and it didn't work out.
I asked this question to somebody else this week regarding bonds and yields and expectations. I mean, if expectations continue to rise, you would think that obviously yields are going to continue higher, bonds are going to get hit. But at what point? But what point do treasuries become more of a value play for portfolio managers? And well, I mean, what are your thoughts there?
Well, I think we're going to find out here within the next week, Blake. It's a great question, timely question, because we got quarter rebalancing coming up. And I do believe that we're going to see some rebalancing where money comes out of equities and starts to move over towards treasuries. But it's got to play out. I mean, so we're in a situation where it's very easy to see why bond prices would keep going down and yields up. We need validation from price. And I was trying to bottom fish on that trade.
Okay. And it didn't work out. I mean, that happened.
It didn't work, but that's the key, I think, of risk management. I'm bottom fishing. So it was a 40% size trade. So it wasn't big. And then had a close stop, 1.5% stop. It's like, okay, done.
Jim, that's what traders do, right? What do we have control over at all times? We have control over our risk, how much risk you're taking, how big your positions are, where your stops are at. And hopefully you don't get a whole lot of slippage, right? I mean, you can't control that,
right?
But you can control like where your stops need to be and where you need to be, get out. And you, my friend, are a trader, and that's why we love you here at Trader Summit. So if I'm a trader at home and I'm trying to figure out how in the hell I follow this Jim Welsh guy around, and I just gave you a thumbs up on YouTube because I like what you're doing down here, so I gave you a thumbs up. But how do I find out more about you?
Macrotides.com, or send me an email, jimwelshmacro@gmail, and I'll send you the most recent weekly technical review.
Awesome. And I'll tell you what, Jim, it's one of the pleasures that I have every week is sitting down and talking markets with you. So guys and gals, if you like what you're hearing here, make sure you give him a thumbs up on YouTube, subscribe to the channel so you don't miss any of our Friday conversations with Jim. Jim, have a great week. I'll see you, and a great weekend. I'll see you next week.
Thanks. You too, Blake.
Thanks for joining us. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.